Welcome to the Secure Your Retirement Podcast. Today we interview Bill Sherman, and it was a super good interview.
We've said it before, buy and hold investing carries too much risk, and Bill Sherman tells us why.
We hope you enjoy the show. Hello, everyone. It's Radon Stansel and Merce Tariq. We are glad and happy to be able to be here today talking with Bill Sherman, and we're excited to have him on our podcast. And I'll explain a little bit about what I know of him and our relationship and how we work together. Merce and I have been talking for some time over the years about needing to be able to look at the markets, the stock market, in a different kind of way, meaning we don't want to look at the markets and think that we have some crystal ball that's going to tell us what's going to happen. We need to look at the numbers and let the numbers tell us where things are headed. And so one of the things that we get from Bill Sherman and his group is we get those numbers. We get that data. And I thought it would be fantastic to have him come on and talk a little bit about his viewpoint, how he got to where he is today, and what makes him believe the way he believes. So, Bill, thank you so much for coming on and talking with us.
It's my pleasure.
Good. Hey, would you just mind telling our listeners and everybody, like, where you're from and kind of where you grew up and where you live now?
Well, is that boring? St. Louis, Missouri, St. Louis, Missouri, and St. Louis, Missouri.
Oh,
although I did spend some time living in the Detroit and Flint, Michigan area, and then in the Fort Wayne, Indiana area shortly after marriage. But born and raised in St. Louis, went to school in Michigan, then graduated with an engineering degree from Washington U in St. Louis after I got married in 1969, and moved to Fort Wayne, Indiana, where I was an engineer on the truck engines line of International Harvester, and moved there, frankly, because they offered a job deferment against the draft in the Vietnam War, and I wasn't anxious to get drafted because I was newly married at the time, and so I moved to there, got a job deferment as an engineer working on contracts that included the U.S. Army. And unfortunately, the draft by lottery system was brought out in 1970, beginning on January 1st. And I was one of the lucky souls that was drafted on February 1st. My draft number was, lottery number was 38. And they went from 31 to 59 on February 1st. And so I was drafted. However, I was rejected by the draft, thankfully, by a kindly old doctor who noted that I was recently married with a pregnant wife we had been married the previous year, and she was due on April 5th. And this was mid-February when I went to the induction center. And this kindly old doctor decided that a fellow with a very pregnant wife shouldn't be in there, and found some reason to reject me medically, which I happily accepted. And found myself out standing in the middle of Broadway in downtown Indianapolis, looking around, wondering what just happened. And so I went back home. My wife, shortly thereafter, thank goodness I hadn't been drafted, shortly thereafter was diagnosed with multiple sclerosis. And she's had that for 50 years and is now disabled. And God knows what would have happened had she been struggling on her own with a newborn. So things worked out. But we moved back to St. Louis to be in the bosom of our families who could help care for Gail, my wife, in her early stages of MS. But one thing that happened at International Harvester changed things for me forever, which is that among the assignments that I had when I was there was to automate the engine labs, the dynamometer labs. And to do so, I called around to the people that sold various components for automation and got real friendly with a fellow from an outfit called Digital Equipment Corporation, DEC, then a very big company and a leader in automation and computers. And he guided me in doing some automation work, and I never forgot that. And I grew very fond of the Digital Equipment Corporation and stuff, and ended up going to work for them in St. Louis when we moved back. My wife was then ill, had a newborn baby and all that stuff. But I was in the computer business from that point on, computers of some sort and programming in particular, and did that for both digital equipment and several other firms on a direct employee or a consultant basis. In fact, I was a consultant to digital equipment in 1989 when I was fast forwarded through a lot of years of programming and consulting. But I was assigned by digital equipment to a project at the Hong Kong Shanghai Bank. And they had huge operations in New York, London, and Hong Kong. And the goal was to tie together all of their currency trading operations through a network that ran on Digital Equipment Corporation computers and workstations. And I didn't know a thing about trading or programming for trading, but I learned a lot of it there. And that was the start of moving into the investment business. It was all, for the first 10 or more years, I guess for the first 10 years, it was dominated by commodities and currencies because that's how I was introduced to it. But in 1998, began to produce information for stock investments and mutual fund investors. And that began what has evolved over time into the service that you are now a participant in, the Sherman Sheet, in which we provide valuable information every day of the week for advisors to use in guiding their clients under one overarching philosophy, and that is disaster avoidance, risk management. In fact, one of our early slogans was disaster avoidance is no accident. And we frequently used a picture of the Titanic sinking into the North Atlantic to illustrate that. Disaster avoidance in the case of those ships in the North Atlantic was taking risk reduction measures. If you were a captain on the nearby SS California, for example, you cut your engines back to idle and didn't go plowing through an iceberg field like the Titanic did, and you avoided catastrophe. And that analogy holds true today, maybe even more so, that disaster avoidance is no accident. It means not having an accident. And that led me to conclude early on that buy and hold investing was simply the Titanic plowing ahead. Some ships make it, some ships don't, but that is an unacceptable risk. So that's the backstory of how we got to be where you are. And I'd be delighted to field more questions before I go off the deep end here.
Yeah, Bill, thank you very much for giving us the whole backstory. And it makes sense that you were an engineer in the past, and then you got into the computers and all that stuff. I mean, everything you do now for what we look for is very data driven. So all of that makes a lot of sense. And so we're going to dive into a few different topics here, but the first one is, you talk about supply and demand and allocating or having a good grip as to where the numbers are in the market, and not so much really guessing about where things are going to go. So I want to talk about asset allocation or what's known as buy and hold, or that's how we call it, buy and hold. You buy a certain set of stocks or mutual funds, and you just kind of hold them throughout. And there's going to be issues here and there, but the idea is at the end of the day, you'll make some money. So what's the main flaw that you see there as far as asset allocation, buy and hold type investing?
Sure. Buy and hold is terrific if you are an institution with an infinite lifespan, because then the problem with buy and hold never bothers you. And the problem with buy and hold is that you lose 50% or more of the value of your holdings from time to time. But if you're an institution with an infinite lifespan, you don't care. You're going to be around for 100 years and it won't make any difference. But if you're a flesh and blood human being that maybe needs that money when the market's down 50%, your life has just been catastrophically changed. And that's the kind of accident that or catastrophic event that we wish to avoid at all costs. And that's why we do a risk-focused investing and assessment of the market, in which we do our darndest to get out of the way, to reduce risk when the measurements that we make that you referred to indicate unacceptably high level of risk that forces us into action. You know, we're not fraidy cats hiding behind the tree from every shadow, but we, by all means, wish to get out of the way of high risk as it plays out in the market, not to anticipate it, not to say, you know, something is going to happen, but when things do happen in the market, we want to make sure that that we interpret them from a risk management perspective and act on them to avoid catastrophe. You know, during, let's say, the most recent years in which this would have been known to all of our listeners was the period between 1999 and 2013. That was a 14-year period during which the S&P was below its peak of 1999, early 2000. It didn't exceed that previous peak until mid-2013, and if you were a NASDAQ investor, it didn't exceed that peak until 2016 or 17. That is a long time to be underwater. Even if you've got an infinite lifespan, that's a long time. But what if you were among the tens of millions of investors who needed their money during that period of time when they were underwater relative to their previous high in the late 90s or early 2000s? And that's the catastrophe that we want to guard against. Take, for example, a 55-year-old at the end of 1999 who thought to himself, hey, I'm in good shape. Some of my tech investments have paid off. If I want to retire at the age of 65, why, all I'll need is average market returns for the next 10 years, and I'll be in great shape. 10 years later, though, in 2009, the market was down 50% or more, just beginning its recovery, and he needed his money. And it's gone nowhere but down over that period of time, particularly if he was a growth or tech investor, and his life was catastrophically changed for the worse. And it's that kind of outcome that buy and hold proponents completely ignore because they take that infinite lifespan perspective, which is completely inappropriate for flesh and blood human beings.
Yeah, that makes perfect sense, and especially for Merce and I, our client, the people we work with are what we define as close to, which means about 10 years with close to retirement or already in retirement. And so their time span is even shorter. And so for them to have protection or risk management is extremely important. And that's one of the things we talk about. Now, here's the thing. Sometimes we find that as we're starting the conversation with someone, or we're talking about it, and maybe they go back and they talk to their current advisor who does much more of the buy and hold, they instantly want to say, yeah, well, there's no way you can time the market. And these guys are trying to time the market. And then we try to explain to our client, which we do, why that's not the case. But I'd like to hear from you. What's the difference, or from your perspective, from what you do and how you provide information, how is that not timing the market?
Well, that's become a pejorative or an insult over the years because the buy and hold proponents use it that way. They use it as a club. But what we do through the perspective of risk management is measure risk, its ebb and flow. And when the flow of risk is unacceptably high, we step aside or we reduce our exposure. And our record of doing so is very good. And the ability to avoid catastrophe is indisputable there. Most people's concept of timing the market is to say, well, this is a top, the market's going down from here, or this is a bottom, market's going up from here, but always thinking about what the market's going to do. We concentrate rather on relatively immediate measurements in the market, and we do it by a variety of means. But one major category that you mentioned early on was the balance of supply and demand. We measure the imbalances of supply and demand and how they play out in the short, intermediate, and long term, because they are a good reflection of the internals of the market. You know, the externals of the market and how things are doing from an external view might be saying one thing, but if you look internally, advancers versus decliners, how much NYSE volume was to the upside, how much to the downside, how many new 52-week highs are being set versus 52-week lows, those sorts of things, which are completely Greek to a layperson, are the inner workings of the market. And those are the things that we pay the most close attention to determine if there's a significant enough deterioration to trigger alarm bells, which should cause us to step aside. And we aren't afraid to get back in. Sometimes the alarm bells trigger and we step aside or reduce exposure. And it turns out that disaster doesn't occur. And when we get a reduced risk signal that the risk has gone away or subsided, we were happy to get back in, and that's okay. One of the major problems of do-it-yourself investors is when they get scared out of the market, they have no idea when to get back in, and they never do. And that you can count millions and millions of investors in that category, particularly after the 2008 and 9 debacle, when tens of millions of investors fled the market and never came back because they didn't know when or how.
Right. So on the topic of supply and demand, how do you, so you've kind of mentioned it, without going too technical, you have a way of defining what's in demand, whether it's, a technology, or whether it's large cap or maybe small caps making a move, or maybe emerging markets. You have a way of tracking that. But then you mentioned that there's a time that we decide to go, in all essence, risk off. Things aren't looking as good from a numbers perspective. What causes that risk off scenario, and how do you see that? How do you unpack it?
Sure. Well, we do it on several time frames, a large scale time frame and a shorter time frames. In a large scale time frame, for example, our supply and demand measurements went negative on January 11th of 2008, which was just at the beginning of the big bear market of 2008 and 9, but it was not at the beginning of the deterioration of supply and demand internals of the market. They had been deteriorating since October, so it was 3 months of deterioration before that triggered that risk off on January 11th of 2008, which was then succeeded in short order by a crash in the market and a rebound in Q4 and another crash into the ultimate March 9th of 2009 bottom. And that we didn't get a low risk signal until May 15th of 2009. So we were on the large time frame. We were out of the market the entire time, and of that crash, which served us very well. Our shorter term time frames have a role to play as well. This year, for example, our shorter term indicator went negative on March 3rd or 4th, I forget which it was, and then went positive again when we had risk reduced in the market after coming off a terrible 35% drop on March 26th. And that allowed us, those who used the shorter term indicator, to avoid almost all of that huge decline in the first quarter of this year, to our great benefit. Our model's doing great this year as a consequence. So we operate on several time frames, and advisors like you can determine which of them are most appropriate for you and your clientele, which to follow, which have the right amount of activity, that sort of thing. But they are all modeled under the same concept, and that is looking for, in their particular time frame, signs of deteriorating internals on a risk reward or on a supply and demand basis, and improving fundamentals at the other end, which on a supply and demand basis, which would allow us to get back in. And we try to keep emotion out of it to the highest degree. We don't let it creep into any of our numbers. We might have emotional feelings about the market. We certainly do, but it doesn't creep into the numbers. And that allows us to overcome a lot of biases that fear and greed can put into decision making. I'll never forget reading a white paper one time from an academic that pointed out that fear has 8 times the motivating power of greed, which means that people are much more likely to act on fear than they are to act on greed, or whatever nicer phrase you want to put for that word. So that means unfortunately, that people flee frequently when the market has a downturn of 25, 35% or more. But fear has so transfixed them, they can't see their way back in because they're fearful of another downturn, fearful of a repeat. And that fear is such a high motivator that it completely clouds their vision and prevents them from making rational decisions. So our decisions we try to make on the basis of factual measurements without letting emotions into the equation at all.
Yeah, I hear what you're saying, and it makes me think. I know in your work you talk a lot about predictions and the financial news networks and how that there's constant predictions. We saw that exact same thing as you talk about this year. We were able to navigate what was a very difficult February, March timeframe. And then we did have to make this decision based on the numbers to get back in. And I will say that for Merce and I, we're looking at the fundamental part of everything. We're looking at the news just like everybody else was with the coronavirus going, but yet the numbers said, hey, it's time to get back in, or at least there's a valid reason to get back in. And that was a tough call to say, get back in. And we had some clients who said, I don't want to get back in. And not many, just literally one or two. But here's what's happened recently, around the idea that we now are sitting in a place where potential of a surge in new coronavirus cases, whether or not how the election, we're recording this prior to the election, but people may be listening to it and we just had an election. But regardless, some people are going, hey, you know what? Just based on that risk of all the news I'm hearing and all the predictions that I'm hearing, I just want to get out. And we talk all the time about, well, when are you going to get back in? So, how do you talk about this whole idea of when you hear this mountain of information around predictions, and you can have 50, 60 predictions every single morning if you get up and read the financial news or watch the news networks? How do you kind of help people think that through a little bit when it comes to that?
Well, mostly by coming to an understanding of why we hear them, and that is because it attracts eyeballs or ears, and that's how those folks get paid, by delivering eyeballs or ears to their TV or radio shows. And so they know that what gathers the most eyeballs and ears is a constant stream of predictions trying to tell us what we can't otherwise know. And those predictions are on the whole worthless. Of course, if you have two people predicting, one saying the market's going to go up and the other saying the market's going to go down, one of them is going to be right on the whole, and the other one's going to be wrong. But how do you know? You can't know in advance. And even the wisest among us who have the biggest pulpits can be completely wrong. I have in mind Paul Krugman, the economist who was a writer at the New York Times on business and economics, who wrote on the night of the election in 2016 that the market was doomed, it was going to go down, and the phrase he used was, my best guess on when it recovers, never. And I'm sure a lot of people who follow his musings were driven from the market as a consequence and missed 4 years of a big run up since then. Who knows what's going to happen in the future? I don't. God does, I guess, but I don't. But I do know that bear markets in the market must be accompanied by deteriorating market internals. Otherwise, they wouldn't be bear markets. And we will discover them in an early enough stage to take action. And if they play out, we will have avoided them. If they don't come to fruition, we'll get back in when they have subsided to the level of acceptable risk. And we won't think twice about it. We'll go forward with no apologies. And in the end, we will survive and thrive, whereas those who don't take any evasive action when risk is high may not survive and definitely won't thrive.
Yeah, Bill, I got to agree. I think, if we were in the situation where we had to invest right this moment based off of the fundamentals, based off of everything that we're seeing, and essentially make a guess, for the next couple months or next couple years or whatever, I would be terrified to make that decision. There's just so much going on. So I'm very happy to say that, we don't have to work that way. And we're in a situation where we can tell clients that we're working off of what we know. And quite honestly, we get a lot of good responses based off of that, because there's so many opinions out there. Everyone's reading all the opinions and they're like, how do you even decide which way to go? Well, luckily we don't have to. But Bill, I think we've got time for one more. And this was a quote that I actually heard you bring up, but I kind of want to understand what it means to you. The quote that you mentioned in one of your talks was basically from Benjamin Graham, who is known as the Dean of Wall Street. He said, the essence of investment management is the management of risk, not the management of returns. Now, we kind of talk about risk management all the time. And, there's always in the investor, the ideal situation is you're making money in the market, making returns. And sometimes that's all they really think about is, getting the 10, 15, 20% up years. But can you unpack that quote for us and what you think it means, how you interpret it?
Sure. The normal investor does just what you described, and that is focus on the potential for big up years and how wonderful that's going to be, without considering the fact that those are going to be accompanied by the occasional horrific bear markets that ruin everything. And one of the things that the Dean of Wall Street, Benjamin Graham's students, Warren Buffett, said, Ben Graham, in addition to being a fabulously successful investor and writer, was also a professor at Columbia University in finance, where one of his students back in the day was a fellow named Warren Buffett, who says even to this day that everything he learned about investing, he learned at the feet of Benjamin Graham. But Warren Buffett has a lot of good phrases worth quoting too, and among them is, you win by not losing. And the essence of that, of course, is that I heard somebody say in football that defense wins games, and that is true in investing as well. If you have no catastrophes in your journey from start to finish in investing, number one, you're not going to get blown out, and you're not going to join the millions of investors who were smoldering by the side of the road because they got burned out and bombed out in the depths of a bear market, and the millions of others who needed their money, no matter how disciplined they were about staying the course as buy and hold investors. If they just simply had to have their money for health or real estate or tuition or just living expenses in retirement, they too were catastrophically affected. So focusing on risk management to ensure that those catastrophically bad outcomes don't occur, yet still being around to participate in the upside is the winning combination. One of the measurements that we apply to our own model portfolios is a set of statistics called up capture and down capture, which is basically the report card for our models. And up capture means what percentage of the market's upside did this model capture? The down capture is what percentage of this model's downside, or this market's downside, did this model capture? And our goal is to capture a quite high percentage of the market's upside while capturing a low percentage of the market's downside. And we have a typical model for us is one that captures maybe between 70 and 90% of the upside. In other words, we are not going to capture all the upside. Our risk management alone is going to ensure that we aren't there at the exact bottom and we aren't there at the exact top. But we'll take that fat part out of the middle. And so if we capture 70 to 90% of the upside, but then turn around and only capture 24 or 25, 27, 30% of the downside, we're in great shape. And that comes up to a ratio typically of 2 to 1, 3 to 1, 4 to 1 upside capture to downside capture. And that's when you've got a real winner on your hands, and that over time, you will capture enough of the upside to forge way ahead by virtue of not capturing very much of the downside. And I know that sounds kind of geeky, but that really is what we strive for. High percentage up capture, low percentage down capture.
Well, that's I mean, everything we hear from you, Bill, is always something that just connects with us. It connects with our clients, the way they think. And I'm positive that just hearing your words and kind of as you are able to articulate some of these thoughts is going to be very, very beneficial to our listeners. So I just want to say again, thank you very much for buying out a little bit of your time to talk to us, to answer our questions, and to share your insights. So we appreciate it very, very much.
Braden, Mers, it was my pleasure.